Hey, Lisa.
Hey, how are you, Dan? Can you hear me?
Yeah, can you hear me okay? I think you're on mute.
How about this?
Yeah, can you?
Yeah, I'm in my car. As soon as I get out of my car, it'll probably work better.
Oh, no, you're good. But can you hear me okay? I just wanted to get feedback from someone
Yes,
there. Okay.
I can hear you. I can hear perfectly. Yeah.
Awesome. Okay. Excellent.
Is it just me today?
No. There's people on. Yeah, I just saw you first. Sorry.
Oh, okay.
Yeah, no, we have quite a few people. There's 12 so far. We'll get started.
Excellent.
Yeah, I'm gonna give a few minutes and then we'll get started.
All right. I might lose you a second, but I'll be back.
No worries. For those of you just joining, I'm just gonna give it like 2 minutes and then we'll get started. You should all be able to see my screen, hopefully with the Hometown Heroes. If you can't, for whatever reason, just let me know. If you're on a cell phone, it might be hard, but anybody else should be able to see it.
I can see it. I'm on myself.
Perfect. Okay.
Hi.
Hello, hello.
Hi, Jen.
Who's that? I'm sorry. Well, whoever said hi, hello. Sorry, I'm sharing my screen, so I can't really see who's on over on the right here. So I'll have to figure out how to enlarge that. But... All right, I'll get started. I'm actually recording this as well. So if someone's late or you guys want, a copy of the audio, just email me after and I'll have one of my team members send it out to you. I do have Liz on my team and Nicole. I just want to give them a quick shout out. Thank you guys for joining us. And what I'm going to do is I'm going to have, if you guys have any questions, first off, if you don't mind just muting yourselves real quick. I mean, this will be pretty informal. If you have a question, I definitely want to get to it, but I just want to go through the presentation quick just for time purposes. And if someone needs to drop off, I want to respect that. So just save your questions on this particular program to the end or put it in the chat and I'll have Liz take a look at those when we're done and she'll just read them off in the order they came in, the questions. But like I said, if you're driving or whatever and you can't put in the chat, that's fine. We'll unmute yourself at the end of the presentation and then I'll try to bang through all the questions. And then we're also just today, so the quick agenda, I'm going to go through the Hometown Heroes program. And then I just want to touch on condos quickly because of some of the new changes, especially with the Surfside incident that happened last year. I think it's really important to know about condos. And then we'll just talk about the market real quick as far as the Fed decision that happened, or the Fed announcement, I should say, that happened on Wednesday. Okay, so without further ado, we will dive into it. Thank you guys all for taking the time. I know it's Friday. I know it's the last day of the month. I know some of you have closing, so I appreciate it. And like I said, I'll try to respect your time, get you out of here within an hour. All right, so Hometown Heroes program, we'll get into this. So this has been around since June 1st. A lot of you have heard about it, seen it on social media. Lenders have been posting about it. So out of all the down payment assistant type programs that I've seen over the years, because that's in essence what this is probably one of the better, if not the best ones that I've seen as far as being able to really assist the homeowner. And they've opened it up to just, you know, a wide array of different professions. And I'll show you guys that through the presentation here, who actually can qualify for this. So I'll go through this slide. I might go, you know, a little quick. So this is just a quick little opening here. Real heroes don't wear capes. Real superheroes wear uniforms and badges and stethoscopes. Real superheroes are members of our military, law enforcement, and first responders. Pretend superheroes wear capes. So that was for you youngins out there, you might not remember, but that was from Dean Cain, the actor of Superman. So about Lois and Clark. So this program, like I mentioned, came out June 1st. It's going to make affordable housing for any frontline workers. So this is going to cover all of your educators, police officers, healthcare providers, childcare, firefighter, nurses, etc. I will give you a summary of all the different ones that qualify for this program, but without getting in like too much detail, just kind of think of this as like anybody within that industry can qualify, you know, because someone asked me, well, is it just the teachers? No, it's the administration staff, you know. Is it just the police and firefighter? No, it's all the people that work behind the scenes as well. So anyone in these fields would potentially qualify for this program. So there's over 50 occupations. Honestly, I think there's probably closer to 90 that can actually qualify. So that's a huge amount. And I'll show you some stats on that as far as how many of these occupations are here in the state of Florida. This is only for the state of Florida, by the way. So if some of you guys like lend or do real estate in multiple states, just keep in mind this is just Florida. So this is interesting, real quick. So how many people could this potentially help? Well, here's just a quick breakdown of the different occupation and how many people are in these fields. So the protective service, you can see there's just over 250,000. Our educational field, there's close to 400,000. Childcare, about 45,000. Healthcare, which is a big one, right? That's 563. Healthcare support, so this is like kind of a lot of your, you know, administrators and whatnot, 285. So that's a big number, right? You take the healthcare in general, that's like 850,000 people right there. And then the biggest whopping one glaring there is the veterans, over 1.5. So you add it all up, there's a little over 3 million people just in the state of Florida that could potentially qualify for this program. So one of the definitions or one of the qualifications is you have to be a first-time home buyer. So what does a first-time home buyer mean? So this is just kind of like the you know, the definition of it here. But some people are confused with first-time home buyer. They think it's, you know, if you've ever owned a home in the past, and that's not the case. It's just you cannot have owned a home as your primary residence within the past 3 years. Okay. So you owned a home back in 2007-8, the market crashed, you were foreclosed on, whatever, then you've been renting ever since, you would qualify. Heck, if you owned a home 4 years ago and sold it and been renting ever since, you would qualify as a first-time home buyer. They even give an example there, which I think is important. So let's say a husband or wife inherits a property in North Carolina, but has not lived in it as their primary residence in the past 3 years, then they would still be considered a first-time home buyer. Right? So if, you know, a parent passes away and you inherit their property, but you've never lived in it, then even though you own a property, it's not your primary, you would qualify as a first-time home buyer. Okay, so that's the general definition, not just for this program. Any first-time home buyer on any program, this is how we define it. And then of course, this is, since it's going to be a primary residence, you have to occupy it within 60 days after closing. That is not specific to this program. That's specific to any primary residence. That's always been our guidelines, that you have to occupy within 60 days. Okay. These are just some of the fees, that they're just basically talking about. There is no origination fee on this program. So some DPA programs, DPA stands for down payment assistance. Some of those programs in the past, the lender was able to charge a fee. Typically, they charge a 1% fee, but on this one, they are not allowing it. So what they are allowing is just their customary fees. So that's just basically what I call your junk fees. Every lender has like an underwriting fee, a processing fee, an application. Those can range anywhere from, on the low end, maybe $700-800, and upwards of maybe $1,500 to $2,000. So those are allowed, but just no origination fees. And then there's the investor. So the investor on this program, this is important to point out, is US Bank. So every lender, every other bank, anybody that's offering this program, it's basically goes through US Bank. So Florida Housing Corporation has some sort of agreement or alliance with US Bank. So we all have to use US Bank or broker the loan through US Bank to qualify for this program. So the good news with that is that pretty much every lender out there is going to be charging the exact same rate. There's going to be no variance with rate. So you're not going to come to us. That's different than, a Chase Bank or a Cross Country or whoever. We're all going to be offering the same rate. So my advice is work with your favorite lender if you're doing this program, because it's not gonna matter. They don't need to go shopping around when it comes to that. So additional fees. I'm not going to spend too much time on this, but the second mortgage, which I'll get into in a second, there's no title insurance on it. This is just one thing to point out. An advantage on this program is that there's no intangible doc stamps tax. So that is going to obviously save the client money when it comes to their closing fees. Principal reduction, I'm not going to really get into that too much. So salute our soldiers. This was a program that was eligible for veterans. There was another DPA program. They are now officially retiring that program, and it's going to be all replaced with this Hometown Heroes program. So there's some people that know about this program, but as of July 1st, they retired it. So now everything is under this. And I will tell you, the Hometown Heroes program, I think, is great for veterans. They stand to benefit the most, and I'll tell you why here in a second. So this is available anywhere in the state of Florida. The Florida Housing Corporation has received, this Ron DeSantis signed off on this bill months ago, but they're receiving $100 million in DPA funds. So it's important to know that, because even though that's a lot of money, they can exhaust through this money. I don't think we're going to have a problem this year because it rolled out halfway through the year. But going into next year, this is a first come, first served type of program. So us as lenders, we're able to monitor on a daily basis how much of the funds have been used thus far. So if we get to, like, let's say August, September, and there's $99 million to use, then yeah, unfortunately, some people are going to miss out. However, Florida Housing is really pushing this program because it's one of those things where, use it or lose it. They want to make sure that they can actually use these funds so they continue to get it. And I believe that if they, exhaust these funds early, that they may go back to the state and request more. So, yeah, but it is important to know that all DPA funds have a cap and a lifespan on them, and it is a first come, first served basis. Okay, so let's talk about how this works. The big thing about this program is there's down payment assistance, which we talked about. You're able to get up to 5% of the total loan amount for a max of $25,000. So nobody can get more than $25,000. But how this works, let me just backtrack for a sec. Most DPA programs, you will get a first mortgage, through your lender, and it'll be whatever program that they're offering. And then you'll usually go to the state or the county, whoever's offering it, and get this DPA loan. So usually a DPA loan is just a second that's offered through the city or state. In order to take advantage of this program, you literally have to do the first mortgage and this down payment assistance second mortgage simultaneously. So you can't get the 5% down payment assistance without doing the first mortgage loan, which, as I mentioned earlier, is through US Bank. Okay, so they come together as a package deal. And what this second is, it's basically a 5% silent second mortgage. It is attached to the property, and it is used solely for your closing costs and down payment. It can't be applied towards the principal of the loan. Actually, they do give you a little wiggle room there. You can use like a max of 1,000 towards the principal if you had some left over, but pretty much it is going towards closing costs and down payment. If for some reason your costs exceed that, then of course they just come up with the difference out of pocket. Same with the opposite. For a veteran, for example, I've gotten this question. Well, how could they use that much? They're doing 100% financing. Well, we would apply all of it to their closing costs where they come into zero. And let's say the veteran was able to get 25,000, their closing costs are only 15, then obviously their max is going to be 15,000. You can't exceed it. So I'll get into this, the second program, second mortgage here in a second. I just want to kind of go through the rest of the slide. The mortgage programs available on the first are all of your standard programs: government, FHA, VA, USDA. I know some of you probably don't even know what that is. We don't do a lot of it down here. It's rural type properties. Then your Fannie and Freddie. This is not available for jumbo loans. Okay, so this is just your conventional and your government loans. Rate locks we do every day. It's posted on the site through US Bank at 10 o'clock. So when it comes to the income limits, this is another big change with DPA. Not everyone can qualify for these programs if they make too much money. And I'll be honest with you, in my experience, especially down here in South Florida, there's very few people that I run across, at least our clientele, that qualify for DPA. And it's because of the fact that they are phased out because they make too much money. This program, they've really increased the maximum income limits. So the AMI is your average median income. So they're going 150% above that. So that's a big amount. So I'm just going to give you like a quick example. Some DPA programs, you couldn't make more than, let's say, about 62,000 combined household income. So if you have, a husband and wife and they're both on the loan, it was usually about 62. Now it's for like Broward County, and I'll show you the chart here later. They'll go up to about 136. So it's literally more than double. So that's a big amount, and that just means more people can potentially qualify for this program based on their income. All right, so here's the second mortgage. Let's talk about that. How does the second work? So like I mentioned, it's a silent second. They take 5% of the loan amount. We talked about that. It's capped at 25,000. It's a 30-year term, but it's at a 0% rate. It's non-amortizing and no monthly payments. So basically, you don't have to pay anything on this loan. It's just going to sit there. If you take out the 25,000, it's sitting there until one of three things happen. You have to pay. It's not forgivable, so that's important to know too, because some DPAs they forgive it over 10 years or whatever the case may be. This is not forgivable, but they do have to pay it back when you either sell the property, when they refinance the property, or when they vacate it as their primary residence. So if you bought this as your primary, 3 years later, you buy a new primary and you move out, then you're going to have to pay it. Okay, so those are the three scenarios that it has to be paid back. But yeah, once again, it's a silent second. It'll sit there, don't have to make a payment, but it does have to eventually pay back. This is just more for us, the additional documentation required. We do have to do a certification. So us as a lender, to be able to offer this program, everyone on my team and myself included have done it. The borrower also has to complete a first-time home buying counseling course. Very easy. There's not much to it. We have this program right now on a 3% down. They have to complete the same course. They can do it online. It's pretty easy. And then they'll get a certificate like I'm showing here on the screen that they've completed their required education. There's also a form that they have to attest to as well. And that's pretty much the end of that. And then I just wanted to go show you guys, and I'll open it up for questions here, but these are all the different occupations. So you can see here, firefighters, law enforcement, educators. So you got the counselors, social workers, specialists, psychologists, librarians, registered nurse, CNA, all your healthcare practitioners. there's a lot. So won't go through each one, but a couple things I just want to say on this program is it's not going to be for everyone. Number one is you have to have a minimum score of a 640. So that's important because FHA and VA, they'll go much lower than that. You know, they can go to a 580, 600. So got to have a minimum of a 640. And based on their debt to income ratio, if it's higher, sometimes you have to have as high as a 680 score. I mean, now, in all honesty, those are not high scores, but I'm just saying to qualify for this program, you do need that. We mentioned you have to be a first-time home buyer. The only one that is excluded from that is veterans. So our veterans do not have to be first-time home buyers. I'm going to tell you guys, I've looked at this program and I've looked at the rates, and I really think who this is going to benefit the most is going to be your veterans. The VA pricing on this is really good compared to regular VA pricing. The conventional pricing, I've priced out a few. I'm going to be honest with you, this program right now is running a little bit higher in interest rates than what we could get on a regular conventional loan if we did not do the Hometown Heroes. So that's why, I'm going to be honest, that's why I didn't really come out of the gate strong on this program right when it came out on June 1st. Me and my team, we really wanted to kind of dissect it, you know, look at it, start pricing loans, see, and that's been kind of our experience so far with it. But, you know, once again, this can definitely help a lot of people. I think it's a great program. It's just not going to be for everyone. So I just want to let you guys know that, because you may say, oh, I got this physical therapist and that's great. She doesn't have much money and she could be a great candidate. Well, we just have to see. We have to see. We'll dissect it. We'll look at her score. We'll look at her ratios. We'll look at the things I just mentioned as far as, you know, is the rate going to be beneficial to her? You know, if someone has 5% down and we price it both and they don't necessarily need the money, they might just want to do a typical conventional loan. So we'll make that determination, but I just wanted to give you guys the heads up that it might not be beneficial for everyone, but obviously this can definitely help some people get into a property that fall, you know, within these parameters. So I know I just dumped a lot on you, but before I get to the next one, anyone want to unmute themselves and ask a question? Or Liz, I don't know if there's anyone in the chat room, but if there is, Liz, if you don't mind just unmuting and let me know.
Sorry, I thought I was unmuted. Okay, can everybody hear me?
Mm-hmm. Yep.
Okay, cool. So the first question was from Luciana. Is there a special rate for first-time home buyers? What is the difference from not first-time home buyers as far as loan programs and who qualifies? Do you still have that question? I think Dan kind of covered that on who qualifies and like the rate.
Yeah, so that, Luciana, I think, yeah, that's what I basically was just saying. So yeah, sometimes it can be, it can be beneficial. I'd say on the government loans, like I said, VA and FHA tend to run lower in pricing than a traditional FHA or VA. But yeah, the conventional just really depends, because there's just a lot of factors with conventional, how much they're putting down, what the credit score is, etc. But like I said, from my experience so far, I've seen this program actually run a little bit higher. So hopefully that answers that.
Okay. And the next question from Lisa, would an IT employee for a police department qualify?
Yeah, Lisa, it would. Anyone, it doesn't really matter so much what they do within that, you know, in that occupation or within that company, as long as they're, you know, within that company. So that's what they have told us from Florida Housing. But if it's something that's a little borderline, what we would probably do is just reach out to them. The guys, the head guy there, his name is Chip. We would just send him a quick email and make sure that they qualify. And on that same note, when it comes to this, someone asked me like, hey, do they have to be working at that job? What if they just got out of school and became a nurse? Or, you know, do they have to be on the job for a certain amount of time? Well, I'd answer it in two different ways. Number one, they got to be able to qualify for a loan period. Remember, these are regular guidelines, so they have to be able to qualify. But to be eligible for this program, no, you just have to be actively working at that place. Doesn't matter if it was 1 week, 3 months, that doesn't make a difference. But of course, you know, the person just has to qualify based on income and everything else. And, you know, if they had a huge gap in employment, that could be a problem no matter how long or that they just started a job in this profession. So just keep in mind, it's regular Fannie guidelines, conventional guidelines that we're looking at, FHA, VA, that all still applies.
Okay. And the next question from Luciana, I'm interested to know of any new program that helps buyers at the jumbo loan with these higher interest rates.
So with jumbo, believe it or not, right now, jumbo loan rates are lower than conventional. I know that sounds kind of crazy, and people, because usually, historically, jumbo are higher, makes sense. Higher loan size, more risk to the lender, therefore they're going to charge a higher rate. But the problem with jumbo, well, it's not really a problem, just jumbo reacts slower to the market, and that could be both good and bad. So an example is during COVID, when rates start to tank, for the better, rates went down, conventional loans react immediately. I mean, sometimes we have price changes multiple times throughout the day, where jumbo lags. So conventional were really low, we got into the twos, everybody and their grandmother was refinancing, where jumbo were still in the upper threes, fours, etc. Now we're seeing the opposite. Jumbo eventually caught up and came down, and now we're seeing rates spike where conventional reacts immediately and jumbo's lagging. So that's why jumbo rates right now are running lower than conventional. But there are, look, we have, some funky jumbo programs. I mean, you can technically get 95% on a jumbo up to an 850 loan size. We have others that will go to 90. Most typical jumbos, I would say, when you get into higher, are 20% down, but there's definitely programs as little as 5%, 10%, etc. It just depends on the person. And then as far as the rates, like I said, jumbo are lower to begin with, but we have been putting a lot of people in ARMs, to offset these higher rates. Like a 10-year ARM, for example, that's a rate that's fixed for 10 years, but it's a 30-year term. Well, I don't really see a lot of risk in that because most people don't stay in their home for 10 years or they're going to refinance, but we truly believe rates are going to come down in the next couple of years. So to get into a 10-year ARM, I really don't see it that risky at all because they're going to have an opportunity to refinance. So, but yeah, feel free to reach out more if you have a specific client about that.
And then the next question from Amy, what is the max combined income amount for Miami-Dade?
Yes, sorry. Let me pull that up here. You guys can see my screen still, right? Liz, you can see, right? Yeah. Okay. All right, perfect. So here's the max loan limits for, it is by county. So you can see there's, various counties, but let's just do the top three here real quick. So Broward, like I mentioned, is 136. Where is, you said Miami-Dade, right? Miami-Dade is 146, so they're about 10K higher. And then Palm Beach is 138. I believe the highest is Monroe. Yeah, so Monroe and the Keys is 153,750. So those are, pretty much the four big counties. Martin, some of you go a little further north. I'll tell you what, if anyone just after this, you can email me. I'll be happy to share not only the presentation, but the loan limits for the various counties as well.
Awesome. And the next question from Luciana, Dan, it says, I just learned this morning in our office sales meeting that some creative lender is offering a 15-year rate on a 30-year amortized loan fixed.
A 15-year rate on a 30-year, I honestly don't know.
in Tampa, yeah.
Yeah, I don't know. Like when you say, yeah, I guess my question would be, how do you know it's a 15-year rate? It just sounds like they're offering a lower rate on a 30-year. I guess, I don't know. You would have to email me separately about that. I'm not really sure, yeah, what they mean. So, I mean, 15-year rates are lower, no doubt, but the term would be lower as well. Okay, so are we good with the questions there on Hometown Heroes? Awesome.
That's all the questions I see. Anybody else have any questions they want to put in the chat?
I'll move on to condos if you guys have anything else. I will tell you guys, Luciana, just on that question with the rates, I mean, there are some creative ways out there. I've mentioned this. I don't have a slide on it, but there's a program that we have right now. It's called the 2-1 buy down. And what it is the seller has to pay for it. I don't know if we're quite ready for seller contributions yet. I don't know if the market has shifted that much. I know some of you guys are seeing price reductions, which is great, or you're seeing homes sit a little bit longer. I don't know if this is relevant, but I'll just throw it out there because it doesn't cost the seller a whole lot. But there's a thing called a 2-1 buy down, and I'm actually going to put a video out on this. But basically, let's say rates are, I'm just going to throw a rate out there. Let's say rates are 6%. Okay. The borrower would be eligible. A 2-1 buy down means that they can get the rate 2% lower in the first year. So the rate would be, it'd go from a 6 to a 4 in year 1. It would go then to a 5 in year 2. And then in year 3, it would go back to the regular rate of 6%. So this really helps the borrower in the first couple of years have a lower payment, especially in year 1. And why I think that's really important is because, like I mentioned earlier, I think rates are going to definitely go down and everyone's going to have an opportunity to refinance. So to have that lower rate for the first year or two would give them a relief. It might put them in the property. Now, the only thing, there's a cost to this. It's not much, and it just depends on the purchase price, etc. But it's a seller paid cost. So it's basically like a seller credit. So the seller would be assisting the borrower in getting that lower rate with the idea of, hey, maybe they can make a full offer because of that, or they qualify because of that, or they're just interested because of that. So it is interesting. It's something that's been around. We're just kind of bringing it back. It's starting to get some publicity now just because of the market we're in and the fact that rates have, increased. So if you want more information on that, I can show you the breakdown, but we did one, we did an example of one and we were going through it. And I want to say the loan size was somewhere in the 300 or 400. And it was literally only about a $3,800 seller credit. I didn't think that was a lot. I mean, and that would literally allow this borrower to get a rate, like I said, 2% lower in year 1 and 1% lower in year 2. So something to consider, something that if we get to that point and need to get creative to keep our buyers engaged. And yeah, I think it definitely could help out. So like I said, I'm going to put a video out on that if anyone has any more questions regarding that. Did we have one more pop in or?
We have one more question. How much are the rates today for a jumbo loan?
1%. No, I'm just kidding. No, rates vary. I mean, jumbo are lower. You could probably get a fixed rate on a jumbo in the upper 4s, where conventional right now might be in the low 5s. So they are running a little bit lower than that. So yeah, you can definitely get upper 4s, and if you do an ARM, it could even be lower than that. Although the ARMs are going to start to tick up here because of the Fed announcement. And here, since we're talking about rates, let me just talk about the Fed announcement real quick, and then we can go to the condos. So you guys know the Fed made their announcement on Wednesday. They increased the federal funds rate another 0.75. So they increased it. I probably have done videos on this the most in my 24-year tenure than any other thing out there, because without fail, I get a text or I get an email or I get a call, be like, oh my God, I just heard the rates went up 0.75%. And that's not the case. I mean, yes, interest rates, the federal fund rate went up 0.25%, but mortgage rates are not tied to that. That's long-term. Mortgage rates are long-term financing. Federal funds rate is short-term. I mean, the federal fund rate is literally an overnight rate that they charge banks to lend money. So you talk about short-term, you don't get any more short-term than an overnight, a one-day rate. It does have a trickle-down effect, but it's mostly in the short-term lending arena. So your credit cards, your car loans, equity lines of credit, that is a big one. Equity lines of credit are directly tied to the federal funds rate. They go off the prime rate, but the prime rate moves parallel to the federal funds rate. So yes, that 0.75 increase has an impact on anybody that has an equity line probably starting next month. It takes like a month or two for their statements to adjust. But the mortgage industry, we go more off of like kind of what the market's going to do or how it's going to react. So that 0.75 increase was built into pricing months ago. So as a matter of fact, there was talk that they might increase a full percent because inflation is out of control. They didn't. So the market was preparing for 0.75. They thought it could be maybe a full percent. So when it did end up only being 0.75, believe it or not, interest rates on mortgages improved a little bit yesterday, because we kind of were pricing in like on to be safe, like on the 1%. When I say we, it's just the market in general, investors and mortgage-backed securities. So yeah, that was actually kind of a relief. So yeah, no, rates did not go up as a result of that announcement yesterday. Matter of fact, they went down a little bit. So the one thing I can tell you with mortgage rates, there's no crystal ball, but if you ever want to follow and just kind of see how they're moving, the 10-year treasury is something you can follow on your app, you know, stock market. If you're following the Dow, the NASDAQ, throw the 10-year treasury in there. And that, how that moves is usually, it's not exact, but it tends to kind of follow how mortgage rates move. But the biggest thing is inflation with rates. You know, mortgage rates hate inflation, you know, and if you think about it like this, someone's like, I don't get it. Like, why is that? Well, if the cost of, you know, inflation keeps going up, and you think about it as an investor, you're lending money out there at, let's say, a 3% rate, but inflation is so high, but you're locked in on a 30-year loan only collecting 3%, even though the cost of everything else is so high, you're losing money. You're actually losing money. So they have no choice but to increase rates. They have to increase rates to offset that inflation. As inflation comes down, then you'll see rates come down. So, and people ask, like, well, why does the Fed, why are they, you know, doing this? Why do they lower it? Why do they increase it? They act, and I've said this before, they act as, like, my best analogy I can give you is they are like the brake and the gas pedal in your car. You know, when COVID was coming out, they got scared. They thought the economy was going to go into, you know, into the toilet, a downward spiral. So what did they do? They were lowering rates. But at the same time, our government's printing money. We're sending, people are getting PPP loans. We're sending financial assistance. And all that did was create a lot of pent up demand. So when COVID kind of went away, what did everyone do? They just came out of their caves. They started spending money, you know, and that just drove up prices like crazy, like overnight. I mean, yes, we had shipping supply issues on top of that. It created the perfect storm. So what is the Fed trying to do now? First of all, they waited and they waited and they waited and they thought, oh, this is transitory. They waited too late. So now what do they have to do? They have to act as that brake. They were revving the gas and now they're slamming on the brakes. So they're just increasing rates. And the reason they do that is to slow down people. If your borrowing costs more to purchase something, then you're going to slow down, right? So that's the whole theory behind it. They can't control inflation completely, but they're trying to do their part, and that's why they increase rates to make it more expensive for people to borrow. Therefore, you might think twice before you go out and buy this or buy that. So that's why we're in it now. The only promising thing that they said is they hinted at the fact that that might be their last significant increase, because 0.75 twice in a row is pretty significant. So will we see future increases? Maybe, but we just got to keep our eye on inflation. If you start to see those numbers come down, then the Fed will be less aggressive with their increasing rates. Any questions on that? I know that was probably a lot, but it's important to know. All right, so I'll move on to condos. And then we'll get you guys out of here early. So condos, a lot of you obviously down here in South Florida, and especially if you guys that work over on the beach or whatnot, you probably run into a lot of condo loans. I believe Faye's on this call. I know Faye does a lot of condos. Because of the Surfside, tragedy that happened last year, condo financing has changed. It's become more strict. And just so you guys know, Florida, out of the entire country, we have the most strict condo guidelines ever since 07 and 08. They are very strict. We took it on the chin big time when it came to condos during the crash. So Fannie and Freddie just haven't let up ever since then. Like, for example, a limited review for down here in South Florida is 75%. For everyone else in the country, it's 90% loan to value. We're at 75, everyone else is at 90. So that just goes to show you what they think about Florida when it comes to condos. Now you add Surfside on top of that, and it's, yeah, now we are officially just winning the award for, you know, strictest on condos. But the big thing to know with that Surfside is what they are trying to accomplish right now is to really go after condos, not go after condos, but just try to regulate them when it comes to structural issues. Okay, so just a quick little recap when it comes to condos. If someone is putting down 25% or more, we can do what's called a limited review. Okay, a limited review, we don't dive into financials, so we don't really care about reserves, but there are going to be items that we're asking for. In the past, prior to Surfside, we would just really look at big ticket items. Big ticket items are, is there any major litigation going on in the building? Is there a single unit owner that owns a monopoly that's more than 20% of the units? These are things that would be an issue on even a limited review. If you were putting down less than 25%, then you had to do a full review. This is where the financials do come into effect, the reserves, and we'd have to look at all that. Now, because of the Surfside thing, they have added additional questions on both the limited and the full. So you cannot get away, you cannot get around this no matter how much you put down. So money is not going to solve this issue on conventional financing. This is what I'm talking about, conventional financing. The questions that they pretty much ask, and I probably should have had Mary on this call, she knows more than me because she does all of our condos, but it's basically, are there any assessments, any deferred maintenance, and are there like the structural integrity of the building? So if some person at the HOA answers yes to those, there's an assessment, we're going to go down the rabbit hole to find out, well, what's it for? What was the reason? You know, if they check, there's obviously structural issues with the property, that's a huge red flag. So they're going to want to know. The other big thing is passing their 40-year the recertification. What Fannie and Freddie are doing right now, and we just had a deal that's probably going to die on us, and this person was doing a full review. We looked at their budget. The reserves are great. They have great reserves. 9 out of 10 times in the past, if I look at a budget and the reserves are great, I'm not worried about a full review at all. The condo even checked off on the questionnaire when it came to structural integrity and all that, that everything was fine. However, it wasn't fine because they did their 40-year cert. Some engineering company notated a lot of deficiencies and concerns with this building, and they reported that to Fannie Mae. So Fannie Mae has flagged this condo in their system. Once they flag you in the system, we're dead in the water with that condo. And when I say we, any lender that's trying to do a review on this condo. This is something new because in the past they wouldn't have done that, but now they're doing it. They're getting a lot more strict with it. So we are trying to go for an exception in submitting this for reevaluation because supposedly they've signed the contract work, they pulled the permits. You know, they're not just totally turning a blind eye on what needs to be done. So we're submitting that to Fannie Mae to see if they'll make an exception since they're operating in good faith here. They're trying to correct the problem. But the issue is that they're like 3 years behind, right? Their 40-year cert was, I think, in 18. And here we are in 18 or 19, and here we are in 2022, and they still haven't corrected it. But it's a process. I mean, some of these things, if you have major renovations, it takes the board voting on it. It takes, you know, assessing people, getting the money to do it. So it's taken them a couple years. But I'll be honest, I'm interested to see if Fannie gives the exception. But it's really important to know if you work with condos, because now what we're doing, and this file happened to be like our guinea pig, is when we look at that budget, we're also going to look at Fannie Mae's system. They have it's called CPM, the Condo Project Manager, and see if anybody's on that list as being flagged. That's going to be a big thing moving forward. So if you have an older building over 40 years, I mean, if you're taking that as a listing, you would be doing your seller and yourself a disservice if you did not ask the condo right up front, did you do your 40-year and did you pass it? If they tell you no, then you're probably going to have issues. So just keep that in mind. Any question? You guys can unmute yourself, but any questions on the condos and what I just covered? All right.
Hi, Dan. How can we check? For example, I'm gonna list an apartment for sale. Can I check if that building is in that list?
Yeah, so what I would do, oops, sorry, I thought I muted my phone. Hold on a second. What I would do is you can email us. So here's the thing, like that list, the CPM list, they don't make that accessible to the public at all. Matter of fact, even myself, I don't have access to it. It's through our condo compliance desk. They have access to it. I think Fannie Mae only wants like, you know, certain lenders, like a certain department to have access to that list. Don't ask me why, but anyway, it's really easy for me to check. You just give me the name of the building and I can email them and they'll let us know. You know, they'll tell us whether it's on the list or not.
Okay, yeah, I'll send it to you because that's an old building and I know they're working on the 40-year, they had been working on the 40-year recertification, but I think they still have things pending. And I'm not sure because they're not very open in the management office to say, you know, I know there's some issue, some liens or something.
Gotcha. Yeah, no, you can definitely, you can absolutely email that. We'll check it out. And you could also email it along with the budget, if you have the budget, because remember, we still want to make sure that their budget's good. If you're doing a full review, if the person's going to put down 25% or more, but regardless, right? Like if you have a listing, you want to know all that stuff up front anyway. So if you do get a buyer that wants to do a full, you know, okay, hey, they're not going to pass a full review. They don't have enough reserves. So the only option is 25% down, right?
Exactly, yes, exactly.
Yeah. I mean, there are, I say that, but there are ways you can do, if they have 10% down, we can break it up with a first and an equity line second. But I will tell you, I think more people are going to shy away from equity lines because of how much rates.
The rates are high.
Yeah. I mean, just think within the last 2 months or 3 months, anyone that has an equity line, your rate just shot up 1.5%. That's a pretty big jump in a short period of time. So I think equity lines were very, very popular with people pulling out equity, doing home renovations. I get it. I'd recommend a lot, but now I think some people are going to think twice about an equity line. So
Thank you.
you got it. Any other condo questions? Trying to think if we've had anything else that you guys need to know. Well, one thing I will tell you about condos. So those are the guidelines once again for conventional. We do have alternative programs when it comes to condos. We have, you know, what we call like portfolio type style or unwarrantable condos. We have one investor right now that doesn't even require a condo questionnaire. I know that sounds like, what? How is that possible? But we literally, we just did one where pretty much most of the building was cash. They'd been turned down from others, but we did not even need to get a condo questionnaire. Now, I will tell you how we look at those people. We are looking at the person, not the building. So they have to be strong, in other words, good credit, decent down payment. When I say decent, like 30% or more, and good assets. So if they meet those criteria, you know, we could do it, no condo needed. So that's really great for condo tells. I mean, any of those funky stuff, co-ops, or just a regular condo that just, you know, maybe they have a large commercial percentage of it and that doesn't fit investor guidelines. But yeah, I would definitely reach out to us on that because I thought this one, you know, we were going to have a hard time with, but we didn't because the buyer was strong.
And there's a question from Josie saying that they heard that they reduced the 40-year recertification. She's asking if that's true and if it only applies to the ones closer to the beach or to all.
Reduce like the time frame for the 40-year?
Yep.
I'll be honest, I don't know. I'd have to, I could check with Mary and get back to you, Josie, on that. Because I haven't heard that, but yeah, Mary deals with all of our condo stuff.
I don't think they reduced the 40-year. They reduced the time because you have to do 40 and then 50 and then every 10 years. And then I think they're reducing this after the 40 years, but I'm not sure either. I heard about they're trying, but they didn't get through. Reduced from 40 to less, but
Okay. Yeah, I thought I heard something too. Now that you say that, to 30, but I don't know if, I don't think that's passed or it's inked yet. But I'm not sure. Yeah, that part I don't know yet. Oh yeah, Lisa said every 20. Yeah, I don't think either way. I don't think that's been finalized yet. But regardless, I think the only thing you guys can do right now is just make sure that you're asking for that if they've done it. And I mean, you know if the building's old, if it's in rough shape or what have you. But yeah, just pay attention to that, because unfortunately, I mean, I guess the good news about this, a lot of condos are going to clean up their act. I mean, we have, believe it or not, gotten a lot of condos through a full review because a lot of them changed their budgets this year because of what happened last year. So we do keep a running list. And if any of you want that, we keep a running list of condo projects that we have approved in the entire state of Florida. I'm happy to email that to anybody that wants it. But I will tell you, it's not a very lengthy list. And it's only because any condo that was approved before, they have to get reapproved now because of the new guidelines with the Surfside. So, but, and honestly, condos need to get reapproved every year anyway, because their budgets change. So, and we have had condos that we did a full review 2 years ago, and then all of a sudden it comes along and they change their budget or, have less reserves or what have you, and they weren't able to get approved the full review. So yeah, that having every year, it has to be reapproved.
Hey, Dan.
Yeah. Hey, what's up, Alan?
Hey, quick question. I'm assuming none of this applies to a cash buyer, correct?
No, I'm not involved with cash, so.
I'm just double checking. Okay, 'cause
Yeah.
the whole review thing and the whole condo thing, just,
Yeah,
investors, they have that, so.
no, exactly. Yeah, wouldn't be an issue with cash. Yeah. I mean, obviously
Thank you.
your client still might want to know, right? If they're buying in there, if it's got
Of
issues.
course,
Yeah,
of course. Thank you.
yeah, absolutely. Cool. And I will tell you guys, just lastly here, if we don't have any other questions, just insurance too has been another kind of hot topic right now. I don't know if you guys have seen and heard, but like Demotech, which rates a lot of the insurance companies, gives them pretty much their A rating, which is what they need. They have threatened to like downgrade that for, I don't know what it was, like 20 different carriers in Florida, but they're fighting that. That's a big deal if they do, because if they downgrade their rating, Fannie and Freddie require you to have an A rating when it comes to insurance. I'm not trying to scare everyone. I'm just saying, I think hopefully they'll be successful in fighting that and making sure that they don't downgrade them, because we already have a small pool of insurance providers here. There's a couple that have gone under. And if any of you know, if any of you are good friends or know an insurance agent, give them a hug, buy them a drink. They are stressed right now. They are literally, having to take they don't make a whole lot, by the way, off a policy. I mean, it's really small that they make, but they're having to take like hundreds of clients that, let's say their carrier dropped them, and I can't think of a couple that just went under recently, and move them all into a new policy. And that is challenging, to say the least. I mean, some of them, their premiums are going up, some of them, the coverage is not the same. So it's really a challenge. So the last thing we need is to put more stress on the insurance agents, because I mean, that's a big thing. I can't tell you. I have people that nickel and dime over a rate of $20, but yet insurance could be a difference of hundreds of dollars a month. And yeah, I mean, I hope that doesn't come to fruition, and I hope the state really steps in and does something about it. Because yeah, insurance is just, it's out of control down here for many, many reasons. So we won't get into it, but just something to keep an eye on.
Who is giving the rate? The rating is at Fannie Mae?
No, Demotech is the rating agency.
Demotech?
I believe I'm saying that right. Yeah, I believe it's called Demotech, that they rate the insurance agencies. But they have to be A rated. I'm just saying Fannie Mae doesn't give the ratings, but they only take A rated policies. So if you're like a B or whatnot, you'd have to get with an insurer that has that A rating.
So if this agency rates Florida, the whole Florida as
It's- it's not all of Florida. It was a lot of the major carriers, but it's not all of Florida. There would still be carriers available, and you always have Citizen, who is the carrier of last resort. Although Citizen sometimes is
no.
first choice. Yeah, sometimes they're cheaper. So
Citizens, we had citizens in my house and they dropped me.
There must-
They no longer provide insurance to my house. And I have with another carrier. My broker had to move me to another carrier.
you might want to reach out to them, because if you weren't able to secure insurance, they're supposed to be able to take you, but there might be something that you either need to correct, or there's got to be a reason.
Yeah,
So the broker might just have to look into that.
I may call them directly.
Yeah, because they'll usually take you if no one else. They almost have to, because they're like the state-backed insurance company.
That's what I always knew about it, but
But if you can get insured by another company, then they don't have to take you.
There you go. And that might be why your broker was able to find you someone else. Yeah.
yeah.
Dan, I have a question.
Yeah. Hey, Maxine.
Okay. Hi. Okay. Hometown Hero program, you have people are getting very excited about that.
Mhm.
I have a buyer. He makes $45,000 a year because he's a teacher,
Mhm.
and he's, got the 2.5% down, a 3.5% down. Great credit, and no debt, but he makes $45,000 a year. So he can afford a $200,000 property. Well,
Right.
so that's a condo.
Right.
So what kind of options would you think would be, I could provide to him? Because quite frankly, there's nothing, I can't, we're holding on by a shoestring before he signs another lease.
No, I
But
get you.
Yeah, but with a $45,000 income,
It's hard. Yeah, it's definitely hard. I mean, regardless of the Hometown Hero program, that's hard to find anything. But yeah, I mean, you could technically find him a condo, and the condo would just have to pass a full review. You can still do the Hometown Heroes, but it's got to pass a full review because it's just a regular Fannie product.
right?
So yeah, you'd have to get the budget. We'd have to check to make sure it's not on that list, etc. So
Yeah, so I need your list of the 3 projects that are approved.
no, there's actually quite a bit on there, but don't be deterred. I tell people this. I sometimes don't like sending out our list because I'm like, just because a condo's not on there does not mean it can't pass a full or limited review. It's just the ones we've done in the last 6 months, 7 months.
If anybody could get it done, it would be Priority Lending.
Well, I appreciate the plug. Thank you.
But you and Ken have come through for me on a couple of occasions where it really saved. It didn't save deals so much as it saved a buyer from losing tremendous amounts of money. And that is what matters. So
No,
thank you.
I appreciate it. And we like condos. I'm not scared of them. I mean, we do so many, and we got the kind of the review process down pat. And listen, I will say this, I probably should have mentioned this in the beginning, but when I was talking about condos, is I've noticed that different lenders have different questionnaires. So I'm going to give you a quick example. I have 2 buddies over at Cross Country, and they have referred me 2 condo loans that they could not do, and we could. And it's just because they are more strict on their, and I'm not trying to single them out. Listen, I'm not trying to single anybody. They're my good friends, and they're great at what they do and everything. But banks too. Let me just start with the bank. I should have started there. Bank of America, Chase. They are super, super strict and have their own. I think they treat every condo as a full review. I don't even think they have a limited review process, but their questionnaires are really lengthy, and they will sometimes create their own overlays. So that's important to know, because some people are like, oh, well, this got shot down by my bank, so I guess it's not, financeable, this condo. And that's not the case. Our questionnaires are pretty simple. Less is more, right? So we just ask what Fannie requires. Nothing more, nothing less. We're not trying to be deceitful. It's just that's what Fannie wants. That's what we're going to give them. But like I said, there's other ones that ask additional questions. They might get too involved, or they could just have their own overlays. An overlay, a good example of an overlay is just, let's say Bank of America, they had a condo loan that went bad. Fannie Mae slapped them on the wrist, made them buy it back. So now Bank of America might be strict on their condos. Everybody like, okay, even though Fannie allows us to do this with X amount, we want this just to play it safe. So that's what they call imposing their own overlays. So that's important to know with condos because, yeah, I've seen different questionnaires with different lenders. All right, no one else has questions. We're right on
Got
the
it.
money.
Thank you.
You got it. So just to, yeah, we have 2 minutes. I love being on time. So I'll let you guys run, but if you want the presentation emailed, if you want the loan limits, I can even make custom flyers for you guys too. If you want to like market this Hometown Heroes, we already have a template set up. Just send me your picture, whatever, and we can co-market that, send it out to you. Just takes a couple days. I just got to send it to our marketing department. But yeah, if you and of course, if you have any questions, just shoot me an email. I'm happy to answer it. Sound good? All right, everyone. Have a great Friday. Have a great weekend. Thank you guys. And hang in there. That's all I can say. Hang in there.
Thank you, Dan.
And
All right. Thank you guys. Take care.